There's something most traders discover too late. Something that changes everything once you finally see it clearly. You can have the most sophisticated strategy, the most powerful indicators, the most expensive charting software, but without this one element, none of that matters. The markets will take everything from you, slowly at first, then suddenly, until you're left wondering what went wrong. That element is discipline. Not the kind of discipline you think you have. Not the surface-level commitment you make when you first start trading. The real discipline. The kind that burns through your ego, tests your patience, and forces you to confront every weakness you've been avoiding your whole life. Most traders never get there. They bounce from strategy to strategy, convinced the next system will be the one that finally works. They chase indicators, follow gurus, buy courses, join trading rooms, and still lose money. Then one day, if they're lucky enough to survive long enough, they realize the problem was never the strategy. The problem was always them. Their lack of discipline. Their inability to follow rules when emotions run high. Their compulsion to trade when they should be waiting. Their tendency to abandon the plan the moment fear or greed takes over. The financial markets are unforgiving. They don't care about your story, your potential, or your intentions. They respond only to your actions. And your actions, whether you realize it or not, are driven by your level of discipline. Every trade you take, every position you hold, every decision you make under pressure reveals exactly how disciplined you truly are. The markets are a mirror. They show you who you are when money is on the line. When you're up and tempted to risk more. When you're down and desperate to recover. When you're bored and looking for action. That's when discipline either saves you or abandons you. Trading discipline encompasses everything. How you prepare before the market opens. How you manage risk on every single trade. How you respond to losses. How you handle winning streaks. How you deal with drawdowns. How you stick to your plan when every instinct screams at you to deviate. How you resist the urge to overtrade. How you maintain consistency day after day, week after week, year after year. This is what separates the few who succeed from the many who fail. The statistics are brutal. Studies show that approximately 70 to 80% of retail traders lose money. Think about that for a moment. 8 out of 10 people who step into these markets walk away with less than they started. The reasons vary, but when you dig deeper, when you look at research from institutions like the Chicago Mercantile Exchange, when you examine the behavior patterns of thousands of traders, one factor emerges above all others. Lack of discipline. Professional traders, the ones who make it, the ones who build careers spanning decades, they all share something in common. It's not that they have secret strategies or insider information. It's not that they're smarter or more talented. Research by Locke and Mann examining professional futures traders found something fascinating. The successful traders exhibited what they termed trading behavior characterized as rational and disciplined. Moreover, measures of relative trading discipline had predictive power for subsequent trading success. Let that sink in. Discipline predicts success. Not intelligence. Not experience. Discipline. When you study the habits of consistently profitable traders, you find patterns. They follow their trading plans with precision. They execute their stop losses without hesitation. They manage risk on every trade according to predetermined rules. They track their performance meticulously. They review their mistakes without ego. They continuously work on their psychology. They treat trading like a profession, not a hobby or a game. This level of commitment doesn't happen by accident. It's cultivated through deliberate practice, brutal self-honesty, and an unwavering dedication to improvement. The psychology behind disciplined trading. Understanding discipline in trading requires understanding yourself. Your mind, with all its biases and emotional triggers, is both your greatest asset and your worst enemy. The human brain didn't evolve to trade financial markets. It evolved for survival in an environment where quick emotional reactions kept us alive. Fear made us run from danger. Greed made us seize opportunities. These instincts served our ancestors well. In trading, they destroy accounts. Behavioral finance research has identified numerous cognitive biases that plague traders. Loss aversion stands as one of the most powerful. Studies demonstrate that losses hurt approximately twice as much as gains feel good. This asymmetry creates predictable behavior patterns. When you're winning, you feel the urge to lock in profits early, afraid the market might reverse. When you're losing, you hold on too long, hoping for a bounce back, unable to accept the reality of the loss. This tendency, known as the disposition effect, appears across all markets and trader populations. Research examining trading records of tens of thousands of individuals found consistent patterns. Investors systematically hold onto losing positions too long while selling winners too quickly. The pain of realizing a loss, of admitting you were wrong, creates such psychological discomfort that traders will watch their accounts bleed rather than accept defeat. Professional traders, however, exhibit different behavior. Their stop-loss execution rates reach 89% compared to just 10 to 15% for retail investors. They've trained themselves to override the natural human tendency to avoid pain. Overconfidence bias wreaks havoc in different ways. After a few winning trades, you feel invincible. You increase position sizes. You abandon stop-loss orders. You convince yourself you finally figured it out. Then one trade wipes out weeks of gains. The market doesn't care how confident you feel. It moves according to forces far beyond your control. Discipline means maintaining the same risk parameters whether you're on a winning streak or a losing streak. Your last 10 trades don't determine what the next trade will do. Confirmation bias clouds judgment in subtle ways. Once you form an opinion about a trade, your brain actively seeks information that supports that view while ignoring contradictory signals. You see what you want to see. If you're bullish, you focus on every piece of positive news while dismissing bearish indicators. If you're in a losing position, you search for reasons why the market will reverse rather than accepting the evidence telling you to exit. Disciplined traders force themselves to consider opposing viewpoints. They actively look for reasons why their analysis might be wrong. The recency bias makes traders overweight recent events when evaluating probability. A few losses in a row and suddenly your strategy seems broken. A few wins and you feel like you can't lose. Neither is true. Your perception of reality gets distorted by what just happened instead of looking at the larger sample size. This is why keeping a detailed trading journal becomes essential. The data doesn't lie. Your memory does. Your emotions do. The numbers show you the truth about your performance over time. Then there's the herd mentality. When everyone around you is buying, the fear of missing out becomes overwhelming. When panic selling erupts, the urge to join the stampede intensifies. Social proof, the psychological principle that we look to others when uncertain, drives traders into poor decisions at the worst possible times. Markets top when optimism peaks and everyone is already in. Markets bottom when pessimism reaches extremes and everyone has already sold. Disciplined traders develop the capacity to stand apart from the crowd, to trust their analysis even when it contradicts popular opinion. Emotional control separates amateurs from professionals. Trading triggers powerful emotions. The exhilaration of a winner. The devastation of a loser. The anxiety of holding through volatility. The frustration of missed opportunities. The anger at yourself for breaking your rules. These emotions are normal, but acting on them is fatal. Research using physiological measurements on day traders found that emotional reactions to market movements varied widely among participants. Those who maintained emotional equilibrium during volatility performed better than those who experienced extreme emotional swings. Self-awareness becomes the foundation of emotional control. You can't manage what you don't recognize. When you feel excitement building as a trade moves in your favor, that's a warning sign. When you feel desperation after a loss, that's dangerous territory. When you feel boredom and start looking for setups that aren't there, you're about to overtrade. The disciplined trader develops an internal monitoring system, constantly checking in on emotional state, recognizing triggers before they lead to impulsive actions. Mark Douglas, whose work on trading psychology is considered definitive, emphasized that trading success is 80% psychology and 20% strategy. While the exact percentages might be debatable, the fundamental insight remains undeniable. Even the most profitable strategy fails in the hands of a trader lacking psychological discipline. You can have an edge that wins 60% of the time with favorable risk-reward ratios, but if you can't execute it consistently because your emotions override your logic, that edge becomes worthless. The psychological transformation required for trading success demands more than reading about it. It requires doing the work. Meditation practices help some traders develop the mental space between stimulus and response. When the market moves against you, that space allows you to choose your action rather than react automatically. Breathing exercises before trading sessions can center your mind, reducing the likelihood of emotional decisions. Physical exercise improves stress management and decision-making capacity. Sleep quality directly impacts impulse control. These aren't luxuries for traders. They're essential components of a disciplined approach. Understanding your personal psychological profile matters immensely. Some traders are naturally more aggressive, drawn to high volatility and quick decisions. Others are naturally more conservative, preferring slower timeframes and smaller risks. Neither is inherently better, but knowing yourself allows you to build a trading approach that works with your psychology rather than against it. Forcing yourself to day trade when your temperament suits swing trading creates unnecessary psychological friction. Discipline includes choosing the right path for who you are. The goal isn't to eliminate emotions. That's impossible. The goal is to prevent emotions from controlling your decisions. You can feel fear and still take the trade when your setup appears. You can feel excitement and still follow your exit strategy instead of getting greedy. You can feel frustration and still stick to your trading plan instead of revenge trading. Emotions provide information about your internal state. Disciplined traders acknowledge them without obeying them. The enemy within: emotional trading. Emotional trading represents the antithesis of discipline. When emotion takes the wheel, logic gets thrown out the window. Your carefully constructed trading plan, the rules you spent hours developing, the risk parameters you know you should follow, all of it disappears the moment powerful emotions flood your system. Fear and greed, the twin demons of trading, drive more account destruction than any market movement ever could. Fear manifests in countless ways. Fear of missing out makes you chase trades after they've already moved. You see a stock ripping higher and convince yourself you need to get in immediately, entering at the worst possible price without proper analysis or risk management. Fear of losing makes you exit winning trades far too early. The market finally moves in your direction, and instead of letting it run to your target, you snatch profits the moment you're up, afraid it might reverse. Fear of being wrong keeps you in losing trades far too long. You watch your stop-loss level approach, then pass it, unable to admit the trade isn't working. Research demonstrates the power of fear in trading. When experimental subjects were shown clips from horror movies before making trading decisions, only 55% wanted to hold their positions compared to 75% of a control group that didn't experience fear induction. Fear physically changes your capacity to think rationally. Your brain shifts into survival mode, shortening your time horizon, narrowing your focus, making you more reactive and less analytical. Inexperienced traders show greater susceptibility to fear compared to professionals. Part of this comes from experience with losses. When you've been through enough drawdowns and recovered, losses become less threatening. You've seen yourself bounce back before. You trust the process. Beginners haven't built that confidence yet. Every loss feels potentially catastrophic. This is why starting with small position sizes matters so much. You need to experience losses that sting psychologically without threatening your ability to continue trading. Greed operates just as destructively from the opposite direction. Where fear makes you too cautious, greed makes you too aggressive. You're up on a trade and instead of taking your planned profit, you hold for more. The market reverses and you watch your gain evaporate. You've had a great trading week and instead of maintaining your usual risk parameters, you increase your position size, convinced you're in a hot streak. Then you give back everything you made and more. Greed tells you the rules don't apply when things are going well. That's exactly when discipline matters most. The cycle of emotional trading follows a predictable pattern. It starts with a normal trade that goes against you. You take a loss. That loss triggers emotional pain, the sting of being wrong, the frustration of losing money. If you haven't developed proper emotional control, that pain demands immediate relief. You want to make the money back right now. So you take another trade without proper setup or analysis. This trade also loses because it was driven by emotion, not logic. Now the pain intensifies. You're down even more. The urge to recover becomes desperate. You increase position size, convinced bigger bets will solve the problem faster. This compounds losses even further. Before you know it, a manageable loss has turned into a catastrophic drawdown. Research on revenge trading, that specific pattern where traders immediately re-enter the market after a loss trying to recover quickly, identifies it as a leading cause of trader failure. Brett Steenbarger, a prominent trading psychologist, describes revenge trading as dangerous and irrational behavior. Yet most traders engage in it at some point. The emotional drive to make back losses overrides rational thought. Your brain literally shifts into a different mode where logic becomes inaccessible. The poker world has a term for this state, being on tilt. A poker player suffers a bad beat, loses a big pot through bad luck, and immediately starts playing recklessly, making poor decisions driven by emotion rather than strategy. Traders go on tilt exactly the same way. One bad trade and suddenly they're taking every setup, abandoning their rules, doubling down on losers, chasing price action, all in a desperate attempt to get back to break even. Sir Isaac Newton, one of the most brilliant minds in human history, lost a fortune in the South Sea bubble. He later remarked that he could calculate the motions of heavenly bodies but not the madness of people. Even genius intellect provides no protection against emotional trading. Anger is particularly dangerous. When you feel angry at the market, at yourself, at your strategy, you make the worst decisions. Anger demands action. It won't let you sit still. So you trade when you shouldn't. You increase risk when you should decrease it. You ignore warning signs and push forward, determined to force the market to give you what you want. The market doesn't care what you want. It moves according to supply and demand, not your emotional needs. Trading angry is like driving drunk. Your judgment is impaired in ways you often don't recognize until after the damage is done. Euphoria creates problems from the opposite emotional extreme. You're having an amazing day, up significantly, feeling like you can do no wrong. This is when overconfidence sneaks in. You start taking marginal setups you'd normally pass on. You increase position sizes beyond your rules. You stay in the market longer than planned because everything is working. Then the market shifts and the euphoria turns to dismay as profits evaporate. Emotional highs are just as dangerous as emotional lows because both states impair rational decision-making. The disciplined trader learns to recognize these emotional states before they lead to destructive actions. When you feel that rush of anger after a loss, that's your signal to step away from the computer. Take a walk. Breathe. Let the emotion pass before you even think about another trade. When you feel excitement building during a winning streak, that's your cue to review your risk management rules, to consciously slow down, to ensure you're still following your plan. Emotional awareness becomes your early warning system. Some traders implement hard stops after emotional triggers. If you take 2 losses in a row, you're done trading for the day. This rule removes discretion when your judgment is most likely to be compromised. If you hit your daily profit target, you stop trading regardless of how good you feel. This prevents giving back gains when overconfidence kicks in. These rules feel restrictive, especially when you're desperate to keep trading, but that's precisely why they work. They protect you from yourself. Physical separation helps manage emotional responses. When you feel strong emotions building, physically leaving your trading space changes your state. Go to another room. Go outside. Change your environment. The act of moving your body can shift your emotional state enough to regain perspective. Some traders keep a rubber band on their wrist and snap it when they notice emotional reaction starting. The small physical sensation interrupts the emotional spiral. Emotional trading destroys more trading accounts than any market crash or economic event ever could. The markets don't take your money. You give it to them through undisciplined, emotional-driven decisions. The traders who survive and thrive are those who develop the capacity to feel emotions without acting on them, to acknowledge fear and greed and anger while refusing to let those feelings dictate their trading decisions. This capacity doesn't develop overnight. It requires conscious effort, repeated practice, and often many painful lessons before it becomes ingrained. Revenge trading and overtrading. Revenge trading deserves special attention because it represents one of the most common and destructive manifestations of undisciplined trading. Every trader, even those who eventually become successful, has fallen into this trap. The pattern is insidious because it feels justified in the moment. You took a loss that shouldn't have happened. Your analysis was correct, but the market did something unpredictable. Or you made a mistake, entered too early or too late, and now you're down money you feel you shouldn't have lost. The immediate response: get that money back right now. This impulse makes evolutionary sense. Our brains are wired to avoid losses and recover from setbacks quickly. In most areas of life, persistence in the face of failure is a virtue. If you fall off a horse, you get back on. If you fail at something, you try again immediately. But trading isn't like most activities. The market doesn't reward immediate persistence after a loss. It punishes it. Revenge trading almost always leads to larger losses because you're operating from a compromised emotional state, making decisions based on what you want to happen rather than what the market is actually doing. The statistics on revenge trading are sobering. Trading coaches and psychologists who work with thousands of traders identify it as a primary reason for failure. The pattern typically unfolds in stages. First, you take a loss. This loss triggers emotional pain and a desire for immediate relief. Second, you take another trade without proper analysis or setup, driven by the need to recover. Third, this trade also loses because it was driven by emotion, not logic. Fourth, the pain intensifies and desperation increases. Fifth, you increase position size, convinced that bigger bets will let you recover faster. Sixth, losses compound as larger positions with poor risk management implode. By the end, a single loss that could have been a minor setback has turned into a catastrophic drawdown. The most dangerous aspect of revenge trading is that sometimes it works. You take that desperate trade and it happens to go in your favor. You recover your loss and feel vindicated. Your brain registers this as success, creating a neural pathway that says revenge trading can solve your problems. This intermittent reinforcement, the random reward, makes revenge trading incredibly difficult to overcome. Like any form of gambling addiction, the occasional win keeps you coming back even though the long-term outcome is predictable. Overtrading represents a related but distinct problem. While revenge trading is triggered by losses, overtrading can happen even when you're winning. It stems from the compulsion to always be in the market, the belief that every move represents an opportunity you should be capturing, the inability to sit on your hands and wait. Many traders convince themselves that more trading equals more money. The opposite is usually true. More trading means more transaction costs, more exposure to randomness, more opportunities for mistakes, and less selectivity in choosing only the highest probability setups. Research on successful professional traders reveals something surprising. They spend the vast majority of their time not trading. One estimate suggests professional traders spend 90% of their time waiting and only 10% actually executing. They're not lazy. They're selective. They understand that opportunities meeting their specific criteria appear infrequently. The rest of the time, the market is either not offering clear setups or doesn't fit their particular strategy. Amateurs see this as leaving money on the table. Professionals see it as avoiding unnecessary risk. Trading frequency correlates inversely with success for most traders. Studies show that traders who make fewer, more selective trades typically outperform those who trade frequently. This finding contradicts what many people expect. Shouldn't more experience through more trades lead to better results? Not when those additional trades are lower quality setups taken out of boredom, impatience, or the compulsion to be active. Quality trumps quantity every single time. The psychological trap of overtrading often connects to deeper emotional needs. Some traders derive their sense of worth from being active, from feeling involved in the market. Not trading feels like not working. The guilt of sitting idle pushes them to take marginal trades. Others trade out of boredom or the need for excitement. The market becomes entertainment, a source of stimulation, rather than a business. When you trade for entertainment value rather than following a disciplined plan, you're gambling, not trading. The two strikes rule provides one effective framework for combating both revenge trading and overtrading. After 2 consecutive losses or after losing a predetermined percentage of your account, you stop trading for the day. Period. No exceptions. This rule removes discretion precisely when your judgment is most likely to be compromised. You might feel fine. You might think you can handle it. You might be certain the next trade will work. None of that matters. The rule is the rule. You stop. Implementing maximum trade limit serves a similar purpose. Decide in advance that you'll take no more than 3 to 5 trades per day, regardless of outcomes. This constraint forces selectivity. If you know you only have 5 bullets for the day, you'll be much more careful about when you pull the trigger. You'll pass on marginal setups because you don't want to waste one of your limited opportunities. This simple constraint can dramatically improve trade quality. Time-based restrictions help some traders. You only trade during specific hours when your focus is best and market conditions typically align with your strategy. Outside those hours, you don't even watch the market. This prevents the temptation to trade when you see movement but conditions don't actually match your criteria. The market is always open somewhere, but that doesn't mean you should always be trading. Recognizing the triggers for revenge trading and overtrading allows you to intervene before engaging in destructive behavior. Common triggers include experiencing an unexpected loss, going from significantly up to significantly down in a short period, hitting your stop loss by a small amount before price reverses, missing a trade that would have been profitable, seeing other traders post big wins on social media, feeling pressure to make a certain amount of money, experiencing boredom after periods of low volatility, or feeling like you haven't traded enough to justify the time spent analyzing markets. When you notice these triggers activating, that's your warning. Your emotional state is shifting into dangerous territory. This is the moment for conscious intervention. Step away from the screen. Take deep breaths. Go through your pre-flight checklist. Review your trading plan and risk rules. Ask yourself if your next trade idea meets all your criteria or if you're just looking for action. Most importantly, give yourself permission to not trade. Doing nothing is a decision. Often it's the best decision you'll make all day. The goal isn't perfection. You will occasionally fall into revenge trading or overtrading patterns. What matters is catching yourself quickly, minimizing the damage, and learning from the experience. Each time you recognize the pattern and choose differently, you strengthen the neural pathways associated with discipline. Over time, the impulse to revenge trade weakens. Not because you stop feeling the emotions, but because you've trained yourself to respond differently when those emotions arise. The power of patience, waiting for your setup. If someone asked you to name the most important skill in trading, what would you say? Technical analysis? Risk management? Psychology? All important, but there's something else that matters even more. Patience. The capacity to wait, sometimes for hours, sometimes for days, doing absolutely nothing except watching and preparing, until the exact conditions you're looking for finally appear. This skill, more than any other, separates consistent winners from everyone else. And it's agonizingly difficult to develop because everything in our modern world trains us to do the opposite. We live in an age of instant gratification. Same-day delivery. Instant streaming. Immediate responses to messages. Everything now, now, now. Then you step into trading where success demands the opposite. Wait. Watch. Do nothing. The market will come to you when it's ready, not when you're ready. This disconnect creates enormous psychological tension. Your brain is screaming at you to do something, anything. The charts are moving. Other traders are taking trades. You're sitting there like a statue. Every fiber of your being wants to act. That's when patience becomes not just a virtue but a survival skill. The action bias, studied extensively in behavioral economics, describes our hardwired tendency to feel better when doing something rather than nothing, even when doing nothing would be wiser. Classic example, studies show goalkeepers in soccer save more penalty kicks by staying in the center rather than diving to either side, yet they almost always dive because doing something feels better than waiting. Traders exhibit the same bias. Markets are moving, so we feel we should be trading. But professional traders know something amateurs don't. Many trading days offer no real edge. The best decision is often to preserve capital and wait for tomorrow. Think about what patience actually means in trading context. It's not passive. It's active preparation without execution. You're analyzing market conditions, identifying key levels, watching for your specific setups, preparing your trade plan, but not pulling the trigger until everything aligns. This requires intense discipline because you might spend hours in this state of prepared readiness without actually trading. The temptation to force a setup, to see what you want to see rather than what's actually there, becomes overwhelming. Professional traders structure their time to support patience. They don't sit watching every tick of every bar waiting for something to happen. They do their analysis, set alerts for key levels or conditions, then step away. When alerts trigger, they return to evaluate whether a genuine setup exists. This approach prevents the screen staring that leads to seeing phantom patterns and taking trades that don't actually meet their criteria. The discipline of stepping away when there's nothing to do protects against the impulse to manufacture action. The statistics on patience in trading are revealing. Research examining trade frequency shows that traders who make fewer, more selective trades typically demonstrate better performance than those who trade frequently. This finding applies across all timeframes and markets. The patient trader who takes 3 high-probability setups per week often outperforms the active trader taking 3 setups per day. Why? Because those 3 weekly trades are the absolute best opportunities that presented themselves. The 3 daily trades include setups that are good enough, maybe, or close enough to the criteria, probably. The difference in quality compounds over time. One study tracking funded traders found that many of them discovered their profitability increased dramatically when they traded less frequently but with greater selectivity. They learned to pass on marginal setups and wait for setups that met all their criteria. This lesson often comes only after painful losses from impatient trading. You chase a setup that's almost right. It loses. You realize that if you'd been patient enough to wait for a setup that was completely right, you'd have avoided that loss and caught the better opportunity that came later. Patience applies not just to entering trades but to holding them. Once you're in a position that's working, patience means letting it run to your target instead of grabbing profits too early. Studies show traders consistently exit winners too soon while holding losers too long. The disposition effect strikes again. Patience fights against this tendency. You planned your exit before you entered the trade. The market is moving toward your target. Nothing has fundamentally changed to invalidate your analysis. Patience means letting the trade work rather than allowing fear to force you out prematurely. The paradox is that patience often feels like torture in real time but looks obviously correct in retrospect. When you're waiting for your setup and hours pass with nothing appearing, impatience builds. You start questioning whether your criteria are too strict. You wonder if you're missing opportunities. You feel the anxiety of sitting on the sidelines while the market moves. Then, finally, your setup appears. You take it. It works. Looking back, you realize all that waiting was worth it for this one good trade. But in the moment, patience requires faith in your process without immediate validation. Developing patience as a skill requires deliberate practice. Start by tracking trades you don't take. Note the setup that almost met your criteria but not quite. Watch what happens afterward. Over time, you build an emotional memory of how waiting paid off, how being selective led to better results. You start to see patience not as restriction but as protection. You're protecting your capital from low-quality trades while positioning yourself for high-quality ones. Some traders gamify patience. They create a journal entry for every day they don't trade when there's no valid setup. They celebrate these non-trading days as wins because they demonstrated discipline. This reframes patience from something that feels like missing out to something that feels like accomplishment. You didn't trade today because nothing met your criteria. That's not failure. That's professionalism. Setting trade quotas helps force selectivity. If you allow yourself only 3 trades per day maximum, you become very picky about which setups are worth taking. You pass on the marginal opportunity because you don't want to use one of your limited bullets on something that's not optimal. This artificial constraint builds the habit of selectivity which eventually becomes natural. The experienced trader develops what might be called comfortable inaction. They're at ease doing nothing. They don't feel anxious sitting on their hands. They trust that opportunities will come. They know their job isn't to trade every day but to trade well when conditions warrant it. This psychological state represents mastery because it means you've overcome the action bias that plagues most people. You've trained yourself to be genuinely patient rather than just trying to force patience while internally screaming with impatience. Patience connects deeply to understanding probability and accepting uncertainty. When you grasp that trading is a probability game rather than a certainty game, patience becomes easier. You know that even the best setups sometimes lose. You also know that waiting for those best setups gives you the highest probability of success over time. You can't control any individual outcome, but you can control the quality of opportunities you select. Patience is how you exercise that control. The lesson every successful trader eventually learns: the market is always there. It will be there tomorrow and next week and next year. You don't have to trade today just because the market is open. Opportunities will continue to appear as long as markets exist. This long-term perspective removes the pressure to act right now. You can wait because there's always another day, another week, another chance for your setup to appear. This mindset shift transforms patience from something you force yourself to endure into something you embrace as fundamental to success. Building your trading plan. Discipline without direction is chaos. You need something to be disciplined about, a framework that guides your decisions, a set of rules that defines how you interact with the market. That's your trading plan. Not a vague idea of your approach. A written, specific, comprehensive document that covers every aspect of your trading. Creating this plan is one thing. Following it consistently is what separates professionals from amateurs. Your trading plan starts with your edge. What specific market behavior are you trying to capture? What pattern, setup, or condition gives you a statistical advantage? If you can't articulate your edge clearly and specifically, you don't have one. You're gambling, hoping random trades will work out in your favor. An edge might be trading breakouts from consolidation ranges, or fading extended moves at key levels, or capturing momentum in trending markets. Whatever it is, you need to define it precisely enough that you could explain it to someone else and they could identify the same setups you would. Risk management forms the foundation of your plan. Before you ever think about potential profits, you define exactly how much you'll risk on any single trade. The professional standard is 1 to 2% of account equity per trade. This isn't arbitrary. This amount allows you to withstand a series of losses, which will inevitably happen, without significantly damaging your account or your psychology. If you risk 5 or 10% per trade, 3 losses in a row sets you back 15 to 30%. Recovery from that kind of drawdown is psychologically and mathematically difficult. Stay within 1 to 2% and 3 losses cost you 3 to 6%. Painful but manageable. Position sizing flows directly from risk management. Once you know you'll risk 1% and you know where your stop loss will be, the math tells you exactly how many shares or contracts to trade. This removes emotion from sizing decisions. You don't take bigger positions because you feel confident or smaller positions because you feel scared. The formula determines your size based on predetermined risk parameters. This discipline prevents the catastrophic mistakes of oversizing when you're wrong or undersizing when you're right. Your plan must specify exact entry criteria. What conditions must be present before you take a trade? Price action confirmation at a key level? Specific candlestick patterns? Indicator alignment? Volume characteristics? The more specific your criteria, the less room for emotional interpretation. Vague rules like trade when momentum looks good invite subjective judgment that varies with your mood. Specific rules like enter when price breaks above the previous day's high with volume 20% above the 20-day average leave no room for debate. Either the conditions exist or they don't. Exit strategy deserves equal attention to entry criteria. Where will you take profits? How will you trail stops on winning positions? Under what conditions will you exit before your stop or target is hit? Many traders focus obsessively on entries while treating exits as something they'll figure out in the moment. This approach guarantees inconsistency. Your best decision-making happens before you have money at risk. Once you're in a position, emotions cloud judgment. Plan your exits in advance and execute them according to plan, not according to how you feel in the moment. Time management belongs in your plan. What hours will you trade? Which sessions align with your strategy? When will you do your analysis and preparation? How much screen time is optimal versus counterproductive? Structure creates discipline. When you trade randomly throughout the day whenever the mood strikes, you're reactive. When you trade specific sessions at specific times, you're professional. The structure also helps prevent overtrading because you're only active during designated hours. Maximum loss limits protect you from catastrophic days. Define how much you can lose in a single day before you stop trading. 2%? 3%? Whatever the number, once you hit it, you're done. Close your platform. Step away. The market will be there tomorrow. This hard stop prevents the revenge trading spiral that turns a bad day into an account-destroying disaster. You might hate stopping when you still have capital to trade, but that's precisely why the rule works. It saves you from yourself. Maximum trade limits serve a similar protective function. How many trades will you take per day? 3? 5? Cap it. This forces selectivity and prevents the machine gun approach of throwing trades at the market hoping something sticks. When you know you only have 3 bullets for the day, you make damn sure each shot counts. You pass on marginal setups. You wait for clear opportunities. Quality improves dramatically when quantity is limited. Your plan should address different market conditions. How do you trade trending markets versus ranging markets? What happens when volatility spikes or contracts? Do you adjust position sizes based on volatility? Many traders develop one approach and try to apply it regardless of market conditions. Then they wonder why they're losing when market character changes. Disciplined traders adapt their execution while maintaining disciplined risk management. Your plan can have different modes for different conditions, but you need to define those modes clearly rather than making it up as you go. Review and analysis procedures complete your plan. When will you review your trades? Daily? Weekly? What metrics will you track? Win rate? Average win versus average loss? Expectancy? Maximum drawdown? How will you identify patterns in your mistakes? The review process is where learning happens. Without regular, structured review, you repeat the same errors indefinitely. With disciplined review, you identify problems, adjust approach, and continuously improve. Writing the plan is easy. Following it is hard. Every trader has moments where breaking the rules feels justified. The setup is almost perfect. The market is moving and you don't want to miss it. You're having a bad day and one more trade might save it. These rationalizations feel so reasonable in the moment. This is where discipline gets tested. You either follow your plan or you don't. There's no middle ground. Every time you break a rule, you reinforce the pattern of undisciplined trading. Every time you follow your plan despite temptation, you strengthen your discipline. Some traders benefit from a pre-trade checklist derived from their plan. Before entering any trade, they physically check off each criterion. Does this setup meet all my entry rules? Is my position size calculated correctly for my risk parameters? Do I have my stop and target clearly defined? Am I trading during my designated hours? Have I already hit my maximum trade limit for the day? This process takes 30 seconds but prevents countless impulsive trades that violate the plan. Your trading plan evolves as you gain experience, but changes should never happen in the heat of the moment. If you identify something in your plan that isn't working, note it during your review process and consider modifications when markets are closed and you're thinking clearly. Making changes while actively trading or immediately after a frustrating loss leads to poor decisions. The plan is supposed to guide you when emotions run high. You can't let emotions drive changes to the plan. Professional traders treat their plan like a contract with themselves. They don't break it just because they feel like it. Would you violate a contract with a business partner because you felt like it? Of course not. Your trading plan deserves the same respect. This commitment to the plan, even when inconvenient, even when seemingly unnecessary, builds the discipline that eventually becomes automatic. You stop thinking about whether to follow the rules. You just follow them because that's what you do. The Trading Journal, your path to self-discovery. Ask any consistently profitable trader about the tools that transformed their results, and most will mention their trading journal. Not just a log of trades taken, though that's part of it. A comprehensive record of everything relevant to your trading process, psychology, and performance. The journal becomes a mirror reflecting your actual behavior versus your intended behavior. It reveals patterns you can't see while trading. It provides objective data when your memory and emotions would distort reality. Without a journal, you're trading blind, making the same mistakes repeatedly without even realizing it. The basic function of a trading journal is recording trade data. Entry price, exit price, position size, stop-loss location, profit target, result. This information lets you calculate important metrics like win rate, average winner versus average loser, expectancy, and maximum drawdown. These numbers tell you whether your approach actually has an edge or if you're fooling yourself with selective memory. Traders often remember their winners vividly while downplaying losers. The journal doesn't lie. The math reveals the truth. But the real power of journaling comes from tracking psychology and process. Before each trade, note your emotional state. Are you feeling confident? Anxious? Bored? Pressured? Note whether the setup fully met all your criteria or if you stretch definitions to justify entry. After each trade, record your emotional response. Did you follow your exit plan or deviate? If you deviated, why? Were you scared? Greedy? Impatient? This psychological data reveals patterns invisible to casual observation. Over time, you start seeing correlations. Maybe you notice that trades taken when you were feeling anxious have a lower win rate than trades taken when you were calm. Maybe you realize that trades where you stretched your criteria to justify entry lose more often than trades meeting all criteria. Maybe you discover that you have trouble holding winners past a certain profit level because fear kicks in. These insights only emerge from systematic tracking over many trades. Your gut feel and memory can't capture these patterns accurately. Studies of professional traders show that most maintain detailed journals and review them regularly. The journal serves as their feedback mechanism, their teacher, their accountability partner. Every trade becomes data that either confirms their approach is working or highlights areas needing adjustment. Without this feedback loop, improvement happens slowly if at all. With it, you accelerate your learning curve dramatically. The journaling format matters less than consistency. Some traders use spreadsheets. Others use specialized trading journal software. Some write long-form narrative entries. The medium doesn't matter as much as doing it every single time. The moment you start skipping trades or only recording winners or being inconsistent with your data entry, the journal loses its value. Discipline in journaling reflects and reinforces discipline in trading. If you can't be disciplined enough to record every trade, you probably can't be disciplined enough to follow your trading plan either. Chart screenshots add another dimension to your journal. Capture the chart at entry, during the trade if something significant happens, and at exit. Weeks or months later, these images will remind you of price context that numbers alone can't capture. You'll remember why you took the trade, what you saw in the market structure, what happened that you didn't anticipate. This visual record accelerates learning because you're not trying to reconstruct market conditions from memory. Recording mistakes is especially important. When you break a rule, when you let emotion override your plan, when you overtrade or revenge trade or get impatient, document it. Write what you were thinking and feeling. Describe the trigger that led to the undisciplined behavior. Note the consequence. These entries might be painful to write because they force you to confront your weaknesses, but they're the most valuable entries you'll make. You can't fix what you don't acknowledge. The weekly review process transforms raw journal data into insight. Set aside time every week to go through your trades. Calculate your metrics. Look for patterns. Which setups performed best? Which performed worst? Did you follow your plan consistently or were there deviations? What emotional patterns appeared? What triggered your best decisions? What triggered your worst? This review shouldn't be superficial. Really dig into the data. Question yourself honestly. Some traders grade their execution separately from their results. A trade can lose money but still represent excellent execution if you followed your plan perfectly. A trade can make money but represent poor execution if you broke your rules and got lucky. When you separate process from outcome, you reinforce that discipline matters more than any single result. You're trying to build sustainable success through consistent execution, not random profits through inconsistent gambling. The long-term view that journaling provides is invaluable for maintaining discipline during drawdowns. When you're in a losing streak, emotions tell you everything is broken and you should change your approach. The journal shows you that you've been through similar drawdowns before and recovered. It shows that your long-term statistics remain solid despite short-term variance. This objective perspective prevents the knee-jerk reactions that destroy trading accounts. Journaling also helps with positive reinforcement. When you successfully demonstrate discipline by following your plan, by waiting patiently for your setup, by taking your stop-loss without hesitation, record and celebrate these wins. Professional execution deserves recognition even when the trade loses. Over time, you build an archive of evidence that you can be disciplined, that you have improved, that the work is paying off. This positive reinforcement strengthens the neural pathways associated with disciplined behavior. Many traders resist journaling because it feels time-consuming. They want to trade, not write about trading. This resistance usually indicates someone who isn't serious about improvement. Professional athletes watch game film. Professional traders review their journals. If you want different results, you need to do things differently than the losing majority. The 20 minutes spent journaling and reviewing will save you hours of frustration and dollars of losses by helping you identify and correct mistakes early. The journal becomes your personalized trading textbook. Instead of learning generic principles from books or courses, you're learning specific lessons customized to your psychology, your mistakes, your strengths, your market conditions. This personalized education is far more valuable than anything you can learn from external sources because it's directly applicable to your actual trading. The trader who maintains a detailed journal for 6 months and reviews it seriously will improve faster than the trader who spends 6 months watching videos and reading books. Some advanced journaling practices include recording trades you didn't take. When you see a setup that almost meets your criteria but not quite, when you feel tempted to trade but exercise discipline and pass, record it. Track what happened afterward. This data shows you whether your patience was justified, whether your criteria are appropriately selective, whether you're missing opportunities or correctly avoiding low-quality setups. Over time, this shapes your intuition about setup quality. The most successful traders treat their journal as sacred. They never skip entries. They never lie to themselves in their notes. They face uncomfortable truths about their behavior and performance. This level of honesty and commitment separates those who eventually succeed from those who never progress beyond the beginner stage. The journal is where you confront reality, learn from it, and use those lessons to improve. Without it, you're just repeating the same cycle hoping for different outcomes. Creating sustainable trading routines. Discipline doesn't exist in a vacuum. It's supported by structure, by routine, by habits that make disciplined behavior easier and automatic. Professional traders don't rely on willpower alone to maintain discipline. They build systems and routines that support disciplined decision-making. Structure reduces the cognitive load of constant decision-making and creates consistency that compounds over time. The morning routine sets the foundation for your trading day. Successful traders often begin their day before the market opens, creating a mental and emotional framework for disciplined trading. This might include reviewing overnight price action in relevant markets, checking economic calendars for scheduled news events, identifying key support and resistance levels on your watch list, reviewing your trading plan and rules, setting alerts for potential setups, and centering yourself mentally through meditation or breathing exercises. This preparation serves multiple functions. Practically, you're ensuring you know what's happening in markets and where opportunities might develop. Psychologically, you're transitioning from your normal life into your professional trading mindset. The routine becomes a ritual that signals to your brain that it's time to focus, to be disciplined, to execute your plan rather than react emotionally. Athletes have pre-game routines for the same reason. The routine prepares mind and body for performance. Physical state impacts mental performance more than most traders realize. Sleep deprivation degrades decision-making capacity, impulse control, and emotional regulation. Research shows that even moderate sleep loss significantly impairs cognitive function and increases risk-taking behavior. Trading while tired is like trading drunk. Your judgment is compromised in ways you might not fully recognize until after you've made poor decisions. Exercise provides multiple benefits for traders. It reduces stress hormones like cortisol that accumulate during trading. It improves mood through endorphin release. It enhances cognitive function and focus. It provides a healthy outlet for the nervous energy that builds when watching markets. Many successful traders schedule exercise before trading sessions, using it to get into an optimal mental state. Others exercise during lunch breaks or after closing to release accumulated tension. Nutrition affects mental performance throughout the trading day. Heavy meals cause energy crashes that impair focus and decision-making. Excessive caffeine creates jitters and anxiety that amplify emotional reactions. Dehydration reduces cognitive performance. Professional traders often eat light, balanced meals and snacks during trading hours, maintain steady hydration, and limit stimulants to avoid the highs and crashes that destabilize emotional equilibrium. Treating your body well supports your mind's capacity for disciplined thinking. The workspace setup matters more than you might think. Cluttered, chaotic environments create mental clutter. Distractions pull attention away from disciplined trading. Successful traders often create dedicated trading spaces that are organized, comfortable, and free from distractions. This might mean a separate room if possible, or at minimum a specific area used only for trading. When you enter that space, you're in professional mode. When you leave it, you're not. This physical boundary helps maintain psychological boundaries. Trading hours should be deliberate rather than arbitrary. Which sessions align with your strategy? When is your mental focus strongest? What times allow you to trade without other life obligations interfering? Define your trading window and stick to it. Many traders make the mistake of staying glued to screens all day, watching every tick, exhausting themselves mentally. This leads to decision fatigue and poor choices. Defined trading hours prevent this trap. You're focused and disciplined during your window, then you step away. The transition out of trading deserves as much attention as the transition in. After your trading session ends, you need a routine that helps you leave trading mode. This might include reviewing the day's trades and updating your journal, calculating daily performance metrics, noting anything important for tomorrow's preparation, physically leaving your trading space, and doing something that shifts your mental state away from markets. Without this transition, you carry trading stress and preoccupation into the rest of your life, which degrades both your personal relationships and your trading performance over time. Rest days are essential, though many traders resist taking them. The compulsion to check markets every single day, to never miss a potential opportunity, drives some traders to trade 7 days a week if possible. This approach leads to burnout, degraded performance, and eventual failure. Professional traders schedule regular breaks. Maybe weekends are always off. Maybe 1 or 2 days per week minimum. These breaks allow mental recovery, maintain fresh perspective, and prevent the staleness that comes from grinding without rest. The evening review creates a feedback loop that accelerates improvement. Spend 15 to 30 minutes reviewing the day's trading. What went well? What went poorly? Did you follow your plan? Where did you deviate and why? What emotions came up? What can you learn from today's experience? This reflection while events are still fresh in memory captures details that would be lost later. The consistency of daily review builds over time into massive improvements. Consistency in routine creates psychological safety. When you do the same preparation ritual every day, when you trade during the same hours, when you follow the same review process, you create predictability that calms your nervous system. Unpredictable environments create stress and anxiety. Structured routines provide a sense of control that supports emotional stability. The discipline of maintaining routine even when you don't feel like it builds the muscle of discipline that serves you in maintaining your trading rules. Some traders implement specific rituals around challenging moments. When they feel emotional reactions building, they have a defined response. Maybe 5 deep breaths. Maybe a short walk. Maybe stepping away for 10 minutes. By planning their response to emotional triggers, they reduce the likelihood of impulsive reactions. The ritual interrupts the automatic emotional response pattern and creates space for conscious choice. Weekend routines support weekday discipline. Use weekend time for deeper analysis and planning without the pressure of real-time markets. Review the week's performance thoroughly. Update your watch lists. Research potential trades for the coming week. Work on your trading education through reading or coursework. This preparation on weekends means you enter Monday ready to execute rather than scrambling to figure out what you're doing. The power of routine is that it removes decision-making from areas where decision fatigue would degrade discipline. You don't decide whether to do your morning preparation. You just do it because that's your routine. You don't decide whether to journal after trading. You just do it because that's your routine. This automation of positive behaviors through habit conserves mental energy for the actual trading decisions where you need full cognitive capacity. Disciplined traders build routines that support discipline rather than relying on constant willpower. Risk management and position sizing. If you learn only one thing about trading, learn this: risk management is everything. Not analysis skills. Not pattern recognition. Not timing entries. Risk management. The way you manage risk determines whether you'll still have an account in 6 months, a year, 5 years. All the edge in the world means nothing if one bad trade or one bad week can wipe you out. Disciplined risk management isn't exciting. It won't make you rich overnight. But it will keep you in the game long enough to develop the skills that eventually lead to consistent profitability. The foundation of risk management is position sizing based on predetermined risk per trade. Professional traders typically risk between 1 and 2% of their account equity on any single trade. This isn't some arbitrary number pulled from thin air. This amount provides mathematical staying power during inevitable losing streaks while allowing meaningful profit accumulation during winning streaks. When you risk 1% per trade, you can lose 20 trades in a row, which is statistically unlikely but possible, and still have 80% of your capital remaining. You survive. You continue. Compare that to risking 10% per trade. 3 losers in a row and you're down 30%. The psychological damage from that kind of drawdown is severe. Your confidence shatters. Fear dominates. You start making desperate decisions trying to recover. The mathematical reality compounds the psychological damage. After a 30% loss, you need a 43% gain just to break even. After a 50% loss, you need a 100% gain. The hole gets deeper and harder to climb out of with each oversized loss. Position sizing math is straightforward but requires discipline to implement. First, determine your risk amount in dollars, account size multiplied by risk percentage. If you have a $50,000 account and risk 1%, that's $500. Second, determine your stop-loss distance in price. If you're buying at $50 with a stop at $49, that's $1 of risk per share. Third, divide risk amount by risk per share to get position size. $500 divided by $1 per share equals 500 shares. This math removes emotion and ensures consistency. Many traders violate position sizing discipline in subtle ways. They calculate correct size based on their account balance, but they haven't updated that balance after recent losses. They're actually risking more than intended because their calculations are based on stale numbers. Or they calculate size correctly but then fail to execute the stop-loss, letting risk expand beyond planned parameters. Or they take multiple correlated positions that all move together, effectively concentrating risk beyond what they think they're risking. The stop-loss is your insurance policy. It defines maximum loss on the trade before entry. Without a predefined stop, you're gambling on hope, convinced you'll know when to exit if things go wrong. Studies show this thinking leads to catastrophic outcomes. Traders without stops hold losing positions far longer than they should, watching small losses become large losses become account-destroying losses. The stop-loss forces you to define risk and accept loss if the trade doesn't work. This acceptance is painful but essential. Stop-loss placement requires balancing technical validity with risk parameters. Ideally, your stop goes where price movement would invalidate your trade thesis, typically beyond recent structural levels like swing highs or lows. But sometimes technically valid stop placement would require position sizes too small to be worthwhile given commission costs. This tension forces choices. Either accept the wider stop and smaller position size, or pass on the trade entirely. What you don't do is ignore risk management because the setup looks good. Discipline means passing on trades that don't allow proper risk management. Trailing stops on winning positions protect profits while allowing room for continuation. As price moves in your favor, you can move your stop to lock in gains. But this requires discipline to avoid moving stops too tight too soon, getting shaken out by normal volatility before the trade fully develops. Professional traders often use percentage-based or indicator-based trailing stop methods that provide systematic rules rather than emotional decisions about when and how much to trail. Correlated risk is a subtle trap. If you take 3 positions in stocks that all move together, you don't have 3 separate 1% risks. You have one 3% risk because if the market moves against your thesis, all 3 positions lose simultaneously. Disciplined traders account for correlation in their risk calculations, either limiting the number of correlated positions or reducing size on each to keep total correlated risk within acceptable parameters. This awareness prevents the surprise of multiple positions collapsing together during market moves. Risk-reward ratios matter for long-term profitability. If your average winner is twice as large as your average loser, you only need to win 40% of trades to be profitable after costs. If your average winner equals your average loser, you need to win over 50% just to break even after transaction costs. Disciplined traders target setups offering at least 2-to-1 reward risk, preferably 3-to-1 or better. This doesn't guarantee profit on any individual trade, but over a sample of trades, favorable risk-reward ratios compound into sustainable profitability. Many traders focus obsessively on win rate while ignoring risk-reward. A 70% win rate sounds impressive, But if your average winner is $50 and your average loser is $200, you're losing money. Simple math, 7 wins of $50 equals $350. 3 losses of $200 equals $600. Net loss of $250 despite winning 70% of trades. Professional traders would rather have a 40% win rate with 3-to-1 risk-reward than a 70% win rate with 1-to-1 risk-reward. The math works better. Maximum loss limits for the day, week, and month protect against catastrophic drawdowns. Define in advance how much you can lose before stopping entirely. Maybe it's 2% per day, 4% per week, 10% per month. Whatever the numbers, once you hit them, you stop. No exceptions. No convincing yourself one more trade will recover losses. This discipline prevents the death spiral where one bad day turns into a bad week turns into a blown account. You accept the drawdown, stop trading, and come back fresh when ready. Account building requires different risk management than account preservation. With a small account, maybe you take slightly higher risk, 2 to 3% per trade, to accelerate growth. But you have to accept higher probability of failure. With a larger account, you reduce risk to 1% or less because preservation becomes more important than aggressive growth. The appropriate risk level depends on your specific situation, but whatever you choose, discipline means sticking to your parameters consistently rather than constantly changing them based on recent results. The psychological benefit of proper risk management is often underappreciated. When you know every trade risks only 1%, when you know no single trade can materially damage your account, you trade with confidence. Fear diminishes. You execute your plan without hesitation because the downside is acceptable. Contrast this with oversized positions where you're terrified of the potential loss, watching every tick, unable to think clearly, stressed to the point where you make poor decisions. Proper risk management creates psychological stability that supports disciplined execution. Risk management is ultimately about survival. Markets are unpredictable. No matter how good your analysis, surprise moves happen. News breaks unexpectedly. Price gaps through your stop. Correlations that usually hold break down. Professional traders assume the worst will eventually happen and position themselves to survive it. Their discipline around risk management means they're still trading years later while the majority who treated risk casually are long gone, wondering why trading didn't work out for them. The long game, consistency over perfection. Trading is not about being perfect. It's about being consistent. Most beginners don't understand this distinction and it costs them dearly. They chase perfect entries, perfect exits, perfect setups. They beat themselves up over every mistake. They expect every trade to win. They think success means never losing. This mindset guarantees failure because perfection is impossible in an environment of uncertainty and randomness. What's possible, what professionals achieve, is consistency. Consistent execution of an edge over hundreds or thousands of trades. That consistency compounds into profitability despite imperfection in every individual element. Think of trading like a casino. The house doesn't win every hand of blackjack. They lose plenty of individual hands. But they have an edge, a small statistical advantage, and they execute that edge consistently over millions of hands. The consistency of execution across a large sample turns their edge into reliable profitability. Traders need the same mindset. You have an edge, hopefully. That edge wins more than it loses or wins bigger than it loses over time. But any individual trade is essentially random. What matters is consistent execution of your edge over many trades. This perspective transforms how you view individual outcomes. A losing trade isn't failure if you executed your plan correctly. It's an expected outcome given that no edge wins 100% of the time. You celebrate the disciplined execution, not the result. A winning trade where you broke your rules isn't success. It's luck that reinforces bad habits. You should actually be concerned about those wins because they make undisciplined behavior seem rewarding, which sets you up for future problems. The goal shifts from trying to win every trade to trying to execute every trade correctly. When you separate process from outcome, when you judge yourself on what you control rather than what you don't, discipline becomes easier. You're not trying to control market outcomes. You're only controlling your own behavior. This is achievable. Market outcomes are not. This focus on process over results is how professionals maintain discipline through the inevitable variance that frustrates beginners. Accepting losses as part of the process is crucial. Losses don't mean you're bad at trading. They mean you're trading. Even the best strategists lose 40 to 50% of trades. If you can't accept that, if every loss feels like personal failure, you'll never maintain the emotional equilibrium necessary for disciplined execution. Professional traders view losses as business expenses. Cost of doing business. You don't take it personally when you pay rent on your office space. Don't take it personally when you pay the market for the opportunity to participate. Losing streaks test discipline more than anything else. When you lose 5 or 7 or 10 trades in a row, doubt creeps in. Maybe your edge is gone. Maybe the market has changed. Maybe you're a terrible trader who was just getting lucky before. These thoughts are natural but dangerous. Statistically, losing streaks happen even with good edges. If you win 60% of trades, you'll still experience strings of losses that feel improbable but aren't. Discipline means continuing to execute your plan through the losing streak, trusting your process, knowing that variance eventually evens out with sufficient sample size. The concept of sample size is critical. You can't evaluate your approach based on 10 or 20 trades. The sample is too small. Randomness dominates. You need hundreds of trades to see whether your edge is real or imaginary. This long-term perspective helps maintain discipline during short-term struggles. You're not trying to prove yourself on today's trades or this week's trades. You're building a body of evidence over months that shows consistent execution and profitable results. Any one period is meaningless. The trend over time is everything. Realistic expectations prevent the discouragement that breaks discipline. New traders often expect to double or triple their accounts quickly. They see social media posts of huge percentage gains and think that's normal. It's not. Professional traders target 20 to 30% annual returns consistently over decades. That seems boring compared to doubling your account in a month, but which is more valuable? A 100% return that you can't replicate, that was mostly luck during favorable conditions, that probably came with huge risk? Or a 25% return you can repeat year after year through disciplined execution of a real edge? Compounding modest consistent returns creates wealth over time. 25% per year doubles your money in less than 3 years. Keep compounding at that rate and a $100,000 account becomes over $2 million in 15 years. Not through gambling or getting lucky or taking huge risks. Through consistent execution of edge with proper risk management. The math works beautifully when given time. But it requires discipline to stay the course, to resist the temptation to swing for the fences, to accept steady progress instead of demanding instant success. Confidence builds through consistent execution regardless of outcomes. Each time you follow your plan despite fear, despite temptation to deviate, despite short-term results, you prove to yourself that you can be disciplined. This evidence accumulates. Your trust in yourself grows. Not because you're winning every trade, but because you're controlling what you can control. Over time, this creates genuine confidence that isn't shaken by losing streaks or market conditions because it's based on your process, not your outcomes. The professional mindset views trading as a marathon. You're in this for years, ideally decades. There's no finish line where you've finally made it and can stop improving. The best traders are constantly refining their approach, learning from experience, adapting to changing markets. But the core discipline of following their rules, managing risk, executing their plan, that remains constant. This long-term commitment means you don't need to figure everything out immediately. You can develop gradually, improve incrementally, knowing that small consistent improvements compound over years into mastery. Perfectionism actually undermines discipline. When you demand perfection, you set yourself up for constant disappointment. Every mistake feels catastrophic. You become paralyzed, afraid to trade because you might not execute perfectly. Or you become reckless, giving up on discipline entirely because you've already violated your standards. Neither response serves you. Professional traders accept imperfection. They make mistakes. They have bad days. They execute poorly sometimes. But they don't let imperfection destroy their commitment to discipline. They learn from mistakes and keep executing their plan. The question isn't whether you'll have losing days, losing weeks, even losing months. You will if you trade long enough. The question is how you respond. Do you abandon your discipline and start revenge trading? Do you increase risk trying to recover faster? Do you freeze and stop trading entirely? Or do you acknowledge the drawdown, review your execution for any lessons, confirm you're still following your plan, and continue trusting your process? That response determines whether temporary setbacks become permanent failure or just bumps in a long profitable road. Consistency creates its own momentum. When you execute consistently for weeks and months, it becomes easier. The discipline becomes habit. You stop thinking about whether to follow your rules. You just do it automatically. This automaticity is the goal. Discipline that requires constant conscious effort is fragile. Discipline that becomes second nature is sustainable. You build that automaticity through consistent repetition over time. Every day you follow your plan moves you closer to the point where disciplined trading is just how you trade, not something you have to force yourself to do. Breaking through psychological barriers. The final barrier to disciplined trading is often the deepest and hardest to overcome. It's not about knowing what to do. At some point, you understand the principles. You know you should follow your plan, manage risk, control emotions, be patient. The information is clear. The real barrier is psychological. Something inside resists consistently applying what you know. This resistance takes many forms, and understanding it is essential for breaking through to the other side. The need to be right is one of the most destructive psychological patterns. Your ego becomes attached to your market opinions. Being wrong on a trade feels like being wrong as a person. This need to be right makes you hold losing trades too long because closing the trade means admitting error. It makes you argue with the market instead of accepting what price is telling you. It prevents you from taking stop losses quickly because that would be admitting you were wrong. Professional traders separate their identity from their trades. A losing trade doesn't make them wrong. It makes them profitable over time by keeping losses small while letting winners run. Fear of success is surprisingly common. Some traders sabotage themselves just as they're starting to make consistent money. They take a huge risk that blows up. They abandon their plan right when it's working. They stop trading when they should keep going. Why? Sometimes success feels unfamiliar, even threatening. If you've struggled financially your whole life, making good money from trading might conflict with your self-image. Your subconscious creates behaviors that return you to your familiar state of struggle. Recognizing this pattern is the first step to overcoming it. Fear of failure operates more obviously but just as destructively. You're so afraid of losing that you don't trade at all. You watch perfect setups pass by, paralyzed by anxiety about what might go wrong. Or you take tiny positions that can't meaningfully grow your account because you're terrified of significant loss. This fear prevents you from ever giving yourself a real chance at success. The irony is that not trading when you should be trading guarantees failure. You fail by never trying rather than trying and learning from outcomes. Attachment to specific outcomes on specific trades creates suffering. You need this trade to win to cover expenses, to recover previous losses, to prove you're not wasting your time. When you attach outcome-based needs to individual trades, you create emotional pressure that degrades decision-making. The market doesn't care what you need. Prices move based on supply and demand, not your hopes and fears. Detachment, the capacity to genuinely not care about any single trade outcome because you're focused on long-term consistency, liberates you from this emotional pressure. The paradox is that you must care deeply about trading while simultaneously not caring about individual trade outcomes. You care about your process, your discipline, your continuous improvement. You care about doing the work, following your plan, managing your psychology. But you don't care whether this specific trade wins or loses because you understand that individual outcomes contain too much randomness to be meaningful. This detached commitment is difficult to achieve but essential for sustainable success. Many traders struggle with the transition from learning to earning. While learning, the pressure is lower. You're studying, practicing, maybe paper trading. Losses don't hurt as much because you're just learning. But once you start trading real money, especially once trading becomes your primary income source or a significant part of your financial life, pressure intensifies. Suddenly every trade matters. Fear increases. This pressure can destroy discipline that seemed solid during the learning phase. Managing this transition requires acknowledging the pressure without letting it control your decisions. You trade the exact same way whether money is on the line or not. The process doesn't change based on psychological pressure. Comparison to others undermines confidence and discipline. You see traders on social media posting massive gains. You wonder why your progress is slower. You start questioning your approach. Maybe you should trade like they do. This comparison trap is deadly because you're comparing your behind-the-scenes reality to someone else's highlight reel. You don't see their losses, their drawdowns, their struggles. You only see what they choose to show. Meanwhile, your focus on others takes energy away from your own development. The only comparison that matters is comparing yourself to your past self. Are you more disciplined than last month? Are you executing better than last year? That's progress. Impatience might be the most common psychological barrier. You want results now. You want to be profitable immediately. You want to skip the years of learning and jump straight to consistent success. This impatience makes you rush through necessary developmental stages. You start trading real money before you're ready because waiting feels unbearable. You risk too much trying to grow your account faster. You jump from strategy to strategy because nothing produces instant results. Professional traders accept that development takes time. They trust the process even when progress feels slow. They know that time invested in proper development pays massive dividends later. The scarcity mindset creates poor trading decisions. When you believe opportunities are rare and you might miss your only chance, you chase trades aggressively. You take marginal setups because you fear waiting means losing money. This belief contradicts reality. Markets provide endless opportunities. There will always be another trade, another setup, another chance. Abundance mindset, the genuine belief that opportunities continuously arise, allows you to be selective. You can pass on today's marginal setup because you trust that better opportunities will appear tomorrow or next week. Self-worth entanglement with trading results creates emotional roller coasters. You're a good person when you win, a failure when you lose. Your mood, your self-image, your sense of value fluctuate with your account balance. This entanglement makes objective decision-making nearly impossible. Your emotional state depends on market outcomes you can't control. Professional traders separate their identity from their trading. They're the same person whether they had a winning day or a losing day. Their self-worth doesn't rise and fall with market prices. This separation creates emotional stability that supports consistent discipline. Trust issues with your own plan and analysis plague many traders. You develop a strategy, test it, see that it works, but when it comes time to execute, you hesitate. You second-guess. You modify at the last moment. This lack of trust stems from either insufficient testing before implementation or past trauma from losses. The solution is either more rigorous testing to build genuine confidence in your edge, or smaller position sizes that reduce emotional impact while you build trust through successful execution. You can't force trust. You build it through evidence accumulated over time. The transformation from undisciplined to disciplined trading rarely happens suddenly. It's not usually one moment of enlightenment where everything changes. More often, it's gradual accumulation of small improvements. You catch yourself about to revenge trade and you stop. One small victory. You wait patiently for your setup instead of forcing a trade. Another small victory. You take your stop loss without hesitation. Another victory. These moments accumulate. Over weeks and months, the disciplined responses become more frequent than the undisciplined ones. Eventually, disciplined trading becomes your default mode. The transformation happened through consistency in small moments, not through one dramatic shift. Some traders benefit from working with sports psychologists or trading psychologists who understand performance under pressure. These professionals help identify hidden psychological barriers and develop strategies for overcoming them. The stigma around seeking psychological help in trading is unfortunate because mental game is where most traders need the most work. Just like professional athletes work with sports psychologists, professional traders often work with experts who help them optimize their psychological approach. Visualization and mental rehearsal can strengthen disciplined responses. Spend time visualizing yourself executing perfectly. You see your setup appear. You feel the impulse to jump in early, but you wait. You see all criteria align and you enter without hesitation. Price moves against you and you watch your stop level approach. You feel fear, but you let the stop execute. You're visualizing the entire sequence of disciplined behavior. This mental practice strengthens the neural pathways associated with those behaviors, making them more likely to occur in real trading situations. Athletes use this technique extensively. Traders should too. The deepest psychological work involves understanding your relationship with money. What does money mean to you? What emotions come up around gaining or losing it? What beliefs about money did you internalize growing up? These deep-seated beliefs and emotions influence your trading behavior in ways you might not recognize consciously. Someone who believes money is scarce and hard to come by will trade very differently than someone who believes money flows abundantly. Someone who associates money with security will respond to losses very differently than someone who associates money with freedom or status. Understanding your money psychology helps you recognize why certain trading situations trigger particular emotional responses. Breaking through psychological barriers ultimately requires brutal honesty with yourself. You have to acknowledge your patterns, your triggers, your weaknesses without judgment or excuse. Most traders spend more energy defending their behavior and making excuses than they spend actually changing their behavior. The moment you stop defending and start observing, real change becomes possible. You see yourself clearly. You recognize patterns as they're happening. You can then choose different responses. This level of self-awareness is uncomfortable but essential for transformation. The transformation from reactive to disciplined. There comes a point in every successful trader's journey where something fundamental shifts. The transition is subtle at first, Hard to pinpoint exactly when it happened, but undeniable once you're on the other side. You're no longer fighting yourself constantly. The discipline that used to require enormous effort starts feeling natural. You're not white-knuckling your way through trades, battling every impulse. Instead, you're operating from a place of calm confidence, following your process because it's simply what you do now. This transformation doesn't mean emotions disappear. You still feel fear when trades move against you. You still feel excitement when trades work perfectly. You still feel frustration when you miss setups. But these emotions no longer control your behavior. There's space between feeling and action. You feel the emotion, acknowledge it, and then choose your response based on your trading plan rather than reacting automatically to the feeling. This capacity for conscious choice in high-pressure moments is what separates professionals from amateurs. You start noticing different things on the charts. Where you used to see every move as a potential opportunity, now you see most moves as noise to ignore. Your attention naturally gravitates toward the specific conditions that matter for your strategy. You're not trying to trade the market. You're waiting for the market to present your specific setup. This selectivity feels effortless because you've trained your perception through repetition. Your brain has learned what to look for and what to dismiss. The relationship with losing changes fundamentally. Losses no longer feel like personal attacks or signs of failure. They're just data points, information about whether that particular trade worked or not. You process them emotionally for a moment, maybe feel disappointment, but then you move on. The loss doesn't linger, doesn't compound into revenge trading or spiraling doubt. You trust your process enough to know that individual outcomes are essentially random, that your edge plays out over many trades, not any single one. This trust wasn't something you could force. It developed through accumulated evidence of your process working over time. Patience becomes your natural state rather than something you struggle to maintain. Waiting for your setup doesn't feel like torture anymore. You're comfortable in inaction because you understand that patience is productivity in trading. Every moment you're not taking a low-quality trade is a moment you're preserving capital for the high-quality trades that will come. This reframe transforms waiting from something that feels like missing out into something that feels like professional discipline. You're proud of your patience, not frustrated by it. Risk management stops being a constraint and becomes a source of confidence. You know exactly how much you're risking on every trade. You know that no single trade can significantly damage your account. This knowledge liberates you from fear. You can execute your plan without hesitation because the downside is acceptable and predefined. New traders see risk management as limiting their profit potential. Experienced traders see it as the foundation that allows them to trade with confidence and consistency. Your preparation becomes more efficient and focused. You're not analyzing everything, trying to predict all market movements. You're looking for specific conditions that align with your strategy. Your pre-market routine takes less time because you know exactly what you need to do. You identify key levels, set your alerts, review your plan, and then you wait. No wasted energy on activities that don't improve your trading. This efficiency comes from clarity about what matters and what doesn't. The need to trade every day disappears. Some days offer no setups meeting your criteria. Instead of forcing trades out of boredom or the feeling that you should be doing something, you simply don't trade. Maybe you close your platform and do something else. Maybe you use the time for education or review. The point is you're comfortable with inactivity when the market isn't presenting opportunities. This comfort with not trading is perhaps the clearest sign of maturity as a trader. Your self-talk changes. The internal voice that used to be harsh and critical, beating you up over every mistake, becomes more neutral and supportive. You talk to yourself like a coach rather than a bully. When you make a mistake, you acknowledge it, identify what you can learn from it, and move forward. You don't dwell. You don't spiral into self-doubt. You maintain the psychological equilibrium necessary for consistent performance. This shift in self-talk didn't happen through positive affirmations or forced optimism. It happened through building genuine confidence via disciplined execution over time. Review processes become something you look forward to rather than dread. Looking at your trades, analyzing your performance, confronting your mistakes, none of this feels threatening anymore. You're not defending your ego. You're gathering data to improve. Every trade, win or loss, contains lessons. Your journal isn't a record of failure but a roadmap for development. This mindset shift transforms review from something painful into something productive. You stop seeking external validation. Your confidence comes from your process and performance, not from what others think or say. You don't need someone to tell you you're a good trader. You have the data. You see the consistent execution, the improving results, the growing account. This internal locus of evaluation makes you far less susceptible to the opinions, predictions, and noise that distract less developed traders. You trust yourself because you've proven to yourself that you can be trusted. The desire to share every trade, to prove yourself to others, to seek recognition for your success, all of that fades. You become comfortable with quiet competence. Your trading is your business, not a performance for an audience. This privacy protects you from the psychological complications that come with public trading. When nobody's watching, you have only yourself to answer to. The discipline becomes purely about your standards, not about maintaining an image. Market conditions that used to frustrate you become simply information. Choppy markets, trending markets, volatile markets, quiet markets, none of it bothers you because you understand that some conditions favor your strategy and some don't. You adapt your expectations and activity level to conditions rather than forcing your approach regardless of context. This flexibility within the structure of disciplined risk management is what allows long-term survival and success. The transformation includes accepting that you'll never have it all figured out. Markets evolve. New patterns emerge. Old patterns stop working. Professional traders continuously learn and adapt while maintaining core discipline around risk management and process. They're humble enough to acknowledge what they don't know while confident enough to execute what they do know. This balance between humility and confidence is delicate but essential. You realize that trading success is mostly about not doing stupid things rather than doing brilliant things. The flashy trades, the perfect timing, the spectacular calls, these aren't what build wealth. What builds wealth is consistent execution of edge with proper risk management, day after day, week after week, year after year. Not losing money unnecessarily. Not revenge trading. Not over-leveraging. Not abandoning your plan. Success comes from boring consistency more than exciting brilliance. The relationship with money matures. Money becomes a tool for keeping score, for measuring whether your process is working, rather than something that defines your worth or determines your emotional state. You become comfortable with fluctuations. Account balance goes up and down and you don't ride that roller coaster emotionally. You're measuring success over longer time frames, not day to day. This emotional stability around money is crucial for maintaining discipline through all market conditions. Eventually, you recognize that the transformation isn't a destination. You don't arrive at perfect discipline and stay there effortlessly. You're continuously maintaining and reinforcing good habits while monitoring for the creep of bad ones. Complacency is the enemy of sustained success. The traders who maintain discipline over decades are those who never stop being vigilant, who never assume they're beyond the psychological traps that catch beginners. They respect the difficulty of what they're doing and never take their discipline for granted. Signs you've truly transformed include following your plan automatically without internal debate, taking losses without emotional spiraling, passing on marginal setups without regret, maintaining consistent position sizing regardless of recent results, executing stops without hesitation, reviewing trades objectively without ego, staying patient through extended periods without setups, making decisions based on your plan rather than your feelings, maintaining emotional equilibrium through both, winning and losing streaks, and focusing on process rather than outcomes. When these behaviors become your default mode, you've crossed over from aspiring trader to professional trader. The beautiful thing about this transformation is that once you achieve it in trading, the discipline transfers to other areas of life. The mental skills you developed, the emotional control you cultivated, the patience you built, all of these serve you beyond the charts. You become someone who can set goals and achieve them through consistent effort. Someone who can delay gratification for long-term benefit. Someone who doesn't quit when things get difficult. Trading becomes a vehicle for developing yourself as a person, not just a way to make money. But getting there requires going through everything we've discussed. Understanding the psychology. Managing emotions. Avoiding revenge trading. Developing patience. Building a comprehensive plan. Journaling obsessively. Creating sustainable routines. Managing risk religiously. Accepting consistency over perfection. Breaking through psychological barriers. Every element matters. Every discipline compounds with the others. You can't skip steps. You can't take shortcuts. The traders who succeed are those who do the work, all of it, consistently, for as long as it takes. The markets will teach you everything you need to learn if you're willing to listen. Every loss contains a lesson. Every mistake reveals something about yourself. Every challenge is an opportunity to practice discipline. The market is the most brutally honest teacher you'll ever encounter. It reflects back exactly who you are. If you're undisciplined, it will take your money until you either develop discipline or quit. If you're disciplined, it will reward you over time with consistent profitability. The choice is yours. The market doesn't care which path you choose. But your future self will care deeply. Trading is simple but not easy. The concepts are straightforward. The execution is difficult because it requires you to consistently do things that feel uncomfortable or unnatural. Fight your instincts. Wait when you want to act. Act when you want to wait. Accept losses. Let winners run. Maintain risk discipline. Stay patient. Control emotions. Follow your plan. Simple concepts. Difficult execution. The discipline required to bridge the gap between simple and easy is what separates the tiny percentage who succeed from the overwhelming majority who fail. You have everything you need to develop that discipline. The information is available. The path is clear. What's required is commitment to doing the work, day after day, regardless of how you feel, regardless of short-term results. Showing up when it's hard. Following your rules when you want to break them. Being honest with yourself about your performance. Learning from mistakes without being destroyed by them. Gradually improving through consistent effort over time. The financial markets offer one of the purest meritocracies that exists. Your background doesn't matter. Your connections don't matter. Your education doesn't matter. What matters is your ability to develop and maintain the discipline required for consistent execution of edge with proper risk management. That's it. Everything else is noise. You can have every advantage in life and still fail at trading if you lack discipline. You can start with nothing but discipline and build substantial wealth over time. So the question becomes, are you willing to do what it takes? Are you willing to develop the discipline that success demands? Are you willing to face yourself honestly, acknowledge your weaknesses, and do the difficult work of changing your patterns? Are you willing to be patient with the process while demanding consistency from yourself? Are you willing to measure yourself against your own standards rather than comparing yourself to others? Are you willing to value process over outcomes and trust that the outcomes will take care of themselves if the process is right? If you commit fully to developing the discipline required for trading success, the markets will eventually reward you. Not immediately. Not easily. But eventually, inevitably, if you persist with disciplined execution. The journey transforms you. The person who achieves consistent profitability isn't the same person who started trading. They've developed mental and emotional capabilities that serve them far beyond the charts. They've become someone who can set ambitious goals and achieve them through disciplined effort. That transformation is worth more than any amount of money you might make. If you found value in today's video, if something resonated with you, if you're committed to developing the discipline we've discussed, I'd love to hear about it in the comments. Share your biggest challenge around discipline. Share what you're working on. Share your progress. We're all on this journey together and learning from each other's experiences. If you haven't already, hit that like button and subscribe to the channel. I create content like this regularly because I believe understanding the mental game of trading is what separates success from failure. Turn on notifications so you don't miss future videos that might help you on your journey. Thank you for spending this time with me. I believe in your potential to develop the discipline that trading demands. The question is whether you believe in yourself enough to do the work. I hope you do. Until next time, trade with discipline, manage your risk, and trust your process.